Hello, welcome again to another US futures trading stream. It is 1:57 Eastern time in the US. FOMC day. The FOMC announcement is just a couple of minutes away. And what do we have here? What do we have here? Let's check. Let's check what's going on. What can happen here? The deal here, what matters in days like this is know what the market is going to do, but we'd rather focus on what the market is doing. Narrow range, very narrow range. Nasdaq is very quite questionable. But Nasdaq is looking like short covering, man. That market looks like short covering. And now this one, after all this trading that happened, more also is looking like that. But pay attention. Look what we have here. What you have here, the daily time frame, and what we have up here as well. Let's check 52.20. These options are crazy expensive now. Well, not that crazy expensive, but they're expensive. How much are these 52.60 calls? 10 points, 2 p.m. 2 hours before the closing, and these are 10 points. Just so expensive. All right. Here we have. Here we go. This is adding, it's making these highs weaker. Let's see if the market now can make a new high. After the announcement, the options kind of like come back to the what could be a regular price. There's a lot of emotions here. A lot of people going short, going long. These stops are out. It's time to go short. No, the all-time highs here. Yeah, let's go long here. What was the announcement? Did they announce rate increase? Doesn't look like. Did they cut rates? I don't think so. If they will cut rates, this market would be right up here now. No, look at these lows here. Look at, not lows, these highs here. They are out now. This one's also been taken, has been corrected. Very close to that. Next thing, new high. Now, this was questionable. That's even weaker now. Well, now we don't have excess. These are single prints, but if we take this high, we don't have excess. On the upper side, now what traders may think now, okay, this has been taken, let's go short now. I am not interested in doing anything human. These days, for the one time you will you go long here. Oh, check this out. Look at where this came from. This is starting from. Oh, exactly. I have a. Look at that, man. Check this out. And where Nasdaq has started. Look at Nasdaq, man. Oh boy. Coming from Cedo. Oh. No, I was saying that. But the one time you got all this movement, man, the next time, there will be 2, 3, 4 times that you won't get it. And you will be shorting the market down here, or getting your market long up here. It's just not worth. No, remember this thing. Remember this. It's a lot of back and forth. Let's come this. Okay, let's see. What is this level here? That one, 55. Did you see that? Did you see this? Okay. Right. I'm going to close, remove these ones. I'm going to put some just okay regular red lines here. Why in the heck do I have daily hardback here? No idea why I put that one there. Remember this level here. Now we have we have a new all-time high. We have nice single prints here. This can be excess. I'm paying attention to this 55 now. Let's see. I want to see volume comes here. The pullback was just below the previous all-time high. Remember what the trade was. The last. Every single time the market has a new all-time high. The trade was keep buying here and then buy pullbacks. Or the test or whatever you wanna call this thing. Why I'm watching this level here? You have 4,000 here, and this is a nice block here. Oh, this is somebody's baiting here. Who's placing a bait here? Either to keep the market higher. Okay, let's check these options now. This one, the 57, the 60 was 12 points before the announcement. 50 to 60, 50 to 60. Now it's 19. Look, 10 points higher, right? Time is selling for 10 points. That. Alright, now do we have a trend? Yeah, this will have an upside continuation with the outside bar. Yesterday we have an outside bar. Very questionable day. Multiple distributions here. But this is working, right? What I have here is this. This is to me or for me. How much are this one? 52, 35, 52, 35, 6 points. 6 points. Keep an eye on that one too. On that put. I'm not doing anything here. I'm just watching how this thing is moving here. the cluster highs has been corrected, right? Oh, I think all these stops are now are history now. Even the ones we have here. 60s, did it get to 70? I was 70, right? I think this one's I may I may have the temptation to tell that these ones are over now. Alright. Watching this here. Now let's come back inside here. Remember this side. This. What was support now is being solved on this level. Is it? No, it's not. But you see how it jumped here, right? This kind of movements, it went from here all the way down to here. In like one movement. Those kind of movements kind of scare the heck out of traders, man. Traders that are long here, they just scare the heck out of those ones. Hey, yeah. How are you, man? It's 10. Oh, that's 13:59. I'm just. Okay. I'm sorry. I didn't see it. There's a good amount of trader on this one here. Remember when I checked this 35 here, this puts, I guess the market was up here. They went from 6 to 8.6, almost 9 now. Alright, look at that. What's the next thing? This level has fall. This one has. This is an intraday. I don't think too many people will be able to see this one. Next thing is half back. Next thing coming back inside previous day range. Nasdaq is already inside range. Right. It seems right. It looks like we have value. Well, I am just watching this histogram here. I'm not looking at this one here right now. Where value starts to build here. This is the area of value of this period. Look at this. We have 100,000 contracts here. Really questionable base here. It is 1/5 of the total volume we have today. In like 10 minutes, volume is almost half of what you're going to have an increase of volume. I don't know how low this was. If I check Jim's website, that would be, okay, let me see. We were 12, minus 12%, maybe this time it's going to be minus 8. Okay. This is what worries me now, right now, as of 2:11 p.m. When I see upside continuation, I usually, what I usually see is this kind of volume building above this level here. I start building up here, but this building below, it doesn't mean anything by itself. No, I don't want to draw any conclusions yet. It is just 12 minutes into the announcement. I will go to YouTube in around 2:25, to look for the Chairman Powell press conference. Oh, come on, I forgot that again. God damn. I was looking at these options. Oh. Okay. This is the second time. Is this the second time it's coming to this level here? No, I don't know what this is. How this can look in like a 5-minute charts. But there is something here. There is something right here. Oh, look at this, man. Look at this. Look at this. Everything is white here. Everything is white here, and this one is just. There is something here. Red is high, purple is medium volume. There's some, but no, it's not. Oh, come on. I'm starting. I guess I'm going to do something. I might do something here. This is support. This is support. We have an upside there. This day is having upside continuation. Oh boy. Let's see. 52.25. 52.25. That's better. Not that better, but now they are selling from this level here. There is something here. There's a battle here. I don't like, ma'am, I don't, okay. You know what the heck, why not, right? I just took I just get a put here. Well, I don't want to see this, I don't want to see the market coming back up here. They're buying from Halbach now. Buying from Halbach. Next thing, Halbach. Oh boy, this is not good. This is just very short term, small trading here. This is how the market can. Okay, this level has been taken. Next thing, I want to see market getting back inside this area, inside this range. Inside this range. Come on. Inside this range. If I am long, I don't want the market to come back inside here. It's buying. There's some buying here coming from this area, right? From today's high. What? No, okay. There are some selling coming from this. This is not good. No, selling coming from Halbach. Buying coming from here. This has the potential to be an excess here. Let's see what happened here. Nasdaq is also trading right there, right at the high of the day. Right at what was the high of the day, I mean. How many times has come back the market to Halbach? This is 4th time. It's coming to check this one. This high was bought once. Nasdaq is already inside the range. There is a big struggle there. You know what? I guess I don't like this. No. There's too much here around this area. I just let it go. But the trade is working, right? The trade was working. That's the thing, right? Sometimes we just are too anxious here. That's something I am looking. I am to change also. Now it's getting back here. Come on, man. Really? God damn it. Look at this. Look at this level here. Right? This is. Oh, come on. How far this one can come inside this range? This is short-term trading. Nothing serious here. And why I say that? Because where everything started. Okay, now that the market is coming back, they may come back inside. They may come back inside this area. How deep this one comes inside this is the question here, because this can be a pullback. What I don't trust is the base we have here. Okay. Can this market take this out at least until at least before Chairman Powell the speech? This is the third time it's coming inside. But it's not having acceptance here. It didn't get back inside value area. The pressure that and this is the thing, right? The pressure that the market is having is very short term here. There's no big action here, right? There's short term trading here going on. I want to see how far this can, again, it's been bought through. There's a lot of buying that's happening here. I haven't seen a spike to the downside. This can be very well be a spike here. You know, this removes the longs, and then we have some upside stage. Now let's check what YouTube has to say here. What is the Fed? Let me see. Okay. Let me open. This is it. This is here. I'll have it here, and this is YouTube, the Federal Reserve. This will go live around 1 minute, maybe exactly at 2:30 p.m. Let's close it up. Now let's see. Now let's check this area, this level again. It is act as a resistance now, or if it even get close to this area here. I'm not checking this, but this, which is the same, right? But overall, you have we have this market was going short. Inventory was short, and those shorts have been taken out of the market. Now inventory is long, has gotten long. Maybe too long here, and there's some rebalancing happening here because the day is to the upside. We have an upside day today, and we have a new high. Right? We have a new high. Remember what happened when we have new highs? Let's put this on the side. There will be some swings during Chairman Powell press conference. At the beginning, the market will go high, maybe close to here, or maybe get close to here, back and forth, or maybe even take, as soon as Chairman Powell takes a microphone, then this low can be taken, and next thing we know, the market is down here. Who knows, man? You never know. The inventory is kind of long now. There is some rebalancing going on. The rebalancing did not take the market back inside this range. Not back inside value here. I had this 52.35. I had this put here, but the market was struggling here. Market came back. I started. It has some continuation, right? Having this as the beginning, I guess I was a little bit late here. It took this half, then this one. It was getting back inside this range. But what happened after that? What the market was started to sell from this level here, sell from here and sell from here, and that's when I said, oh, this is not good now. Now, can we go higher now? The Nasdaq looks really bad, man. Nasdaq, both. I don't like this one, but Nasdaq is even worse than this. And if Nasdaq, the thing is, I think that if Nasdaq cannot hold, that market can drag this one. Let me get something to drink. I'll be back in a second. Now let me see how much are these 52.70. 52. Oh, that's 8 points. That's a lot yet, man. Okay, let's check now. I'm going to put this thing here. Hold on. I don't know if you can hear me now. Okay, this is the stream. All right. Okay. Here we go.
Good afternoon. My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and
How
stable
about you?
prices for the American people. The economy has made considerable progress toward our dual mandate objectives. Inflation has eased substantially, while the labor market has remained strong. And that is very good news. But inflation is still too high, ongoing progress in bringing it down is not assured, and the path forward is uncertain. We are fully committed to returning inflation to our 2% goal. Restoring price stability is essential to achieve a sustainably strong labor market that benefits all.
Two distributions here. This is key now. This area, this level. Now it was coming back and forth. Now it's key.
Our restrictive stance of monetary policy has been putting downward pressure on economic activity and inflation. As labor market tightness has eased and progress on inflation has continued, the risks to achieving our employment and inflation goals are moving into better balance. I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has been expanding at a solid pace. GDP growth in the fourth quarter of last year came in at 3.2%. For 2023 as a whole,
The backgrounds what we have yesterday here. No, but now this level is key. It's becoming really important now. And was bought from here again. This is, I don't know how many times was bought from here before, then held back, and now it's not even getting closer to this range.
in our summary of economic projections, committee participants generally expect GDP growth to slow from last year's pace, with a median projection of 2.1% this year and 2% over the next 2 years. Participants generally revised up their growth projections since December, reflecting the strength of incoming data, including data on labor supply. The labor market remains relatively tight, but supply and demand conditions continue to come into better balance.
Look, this one
Over the
again.
past 3 months, payroll job gains averaged 260.
I guess this market had could also coming maybe around this area, maybe POC. I know, if that doesn't happen, it's
Been accompanied by an increase in supply of workers, reflecting increases in participation among individuals aged 25 to 54 years, and a continued strong pace of immigration.
here.
Nominal wage growth has been easing, and job vacancies have declined. Although the jobs to workers gap has narrowed, labor demand still exceeds the supply of available workers. FOMC participants expect the rebalancing in the labor market to continue, easing upward pressure on inflation. The median unemployment rate projection in the SEP is 4.0% at the end of this year and 4.1% at the end of next year. Inflation has eased notably over the past year, but remains above our longer-run goal of 2%. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.5% over the 12 months ending in February, and that excluding the volatile food and energy categories, core PCE prices rose 2.8%. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as from measures from financial markets. The median projection in the SEP for total PCE inflation falls to 2.4% this year, 2.2% next year, and 2% in 2026. The Fed's monetary policy.
Notice how the market has retraced cues of a good part of this spike here that has this base. I don't know if this one can be taken, but most of this inventory now has been rebalanced. This trade, don't while it has this area, as a potential destination, it doesn't necessarily has to come back all the way down to here and take this one to be completed. That is what's that is monitoring for continuation, right? You see the market coming, working its way down, working its way, kind of like a struggling here, right? Just like, I had the assignment. I had to take this one out, right? And that's just short-term trading. That's a trade. That's part of the trade.
Back policy restraint at some point this year. The economic outlook is uncertain, however, and we remain highly attentive to inflation risks. We are prepared to maintain the current target range for the federal funds rate for longer, if appropriate. We know that reducing policy restraint too soon or too much could result in a reversal of the progress we have seen on inflation and ultimately require even tighter policy to get inflation back to 2%. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. The committee does not expect it will be appropriate to reduce the target range until it has gained greater confidence that inflation is moving sustainably down toward 2%. Of course, we're committed to both sides of our dual mandate, and an unexpected weakening in the labor market could also warrant a policy response. We will continue to make our decisions meeting by meeting. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the
What I feel is that unless the labor market collapses, falls, he's saying it's not going to cut rates unless that happens.
That the appropriate level of the federal funds rate will be 4.6% at the end of this year, 3.9% at the end of 2025, and 3.1% at the end of 2026, still above the median longer-term funds rate. These projections are not.
Now he's saying he at least 2 cuts this year.
Will adjust as appropriate to foster our maximum employment and price stability goals. Turning to our balance sheet.
The market like that.
$1.5 trillion since the committee began reducing our portfolio.
Hey,
At this meeting, we discussed issues related to slowing the pace of decline in our securities holdings. While we did not make any decisions today, the general sense of the committee is that it will be appropriate to slow the pace of runoff fairly soon, consistent with the plans we previously issued. The decision to slow the pace of runoff does not mean that our balance sheet will ultimately shrink by less than it would otherwise, but rather allows us to approach that ultimate level more gradually. In particular, slowing the pace of runoff will help ensure a smooth transition, reducing the possibility that money markets experience stress and thereby facilitating the ongoing decline in our securities holdings consistent with reaching the appropriate level of ample reserves. We remain committed to bringing inflation back down to our 2% goal and to keeping our longer-term inflation expectations well anchored. Restoring price stability is essential to set the stage for achieving maximum employment and price stability over the long term. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you.
Steve Leisman, CNBC. Mr. Chairman, the projections show somewhat higher core inflation. They also show somewhat stronger growth. What should we infer from this notion that on average rates were kept the same this year, but inflation is higher and growth is higher? Does it mean more tolerance for higher inflation and less of a willingness to slow the economy to achieve that target?
Well, it doesn't. No, it doesn't mean that. What it means is that we've seen incoming, as I pointed out in my opening remarks, we did mark up our growth forecast, and so have many other forecasts.
He doesn't like Leisman.
Well, and the inflation data came in a little bit higher in a separate manner, and I think that caused people to write up their good progress on bringing inflation down. And
That was a
so,
good question there.
When you, just to follow up, when you say that you're willing to either maintain the rate for longer, what is the tolerance of the Federal Reserve for inflation coming in above its 2% target?
so we're strongly committed to bringing inflation down to 2% over time. That is our goal, and we will achieve that goal. Markets believe we will achieve that goal, and they should believe that, because that's what will happen over time. But we stress over time. And so I think we're making projections that do show that happening, and we're committed to that outcome, and we will bring it about.
Rachel.
Hi, Chair Powell, Rachel Siegel from the Washington Post. Thanks for taking our questions. You and others have been saying that relief on housing inflation is coming, but it still hasn't shown up meaningfully in the CPI or the PCE. Does that challenge your assumption about when the shift will finally break through, since it hasn't at that point?
So I think there's some confidence that the market rents, lower market rent increases that we're seeing will show up in measures of housing services inflation over time. There's a little bit of uncertainty about when that will happen, but there's real confidence that they will show up eventually over time. But again, uncertainty about the exact timing of that.
Housing doesn't break through quickly, and does that affect the timing for eventual cuts this year?
We will get aggregate inflation down to 2% over time. We will. And I would assume that what we'll continue to see is we'll see goods prices coming into a new equilibrium where they're going down perhaps not as quickly as they had been earlier this year, where housing services inflation will come back down as current market rents are suggesting will happen, and where non-housing services will move back down. Some combination of those three things, and it may be different from the combination we had before the pandemic, will be achieved and will bring inflation back down to 2% sustainably.
Nick Timmeros of the Wall Street Journal. Chair Powell, during your congressional testimony this month, you said that your test for making the first change to interest rates does not require you to be terribly comfortable that inflation is at 2% because interest rates are well above neutral. At the same time, you said here after the last meeting that the first cut is highly consequential. Can you reconcile these views for me? If rates are well above neutral, why would the first cut be highly consequential? Is that because you anticipate one cut would be followed by one or two more along the lines of the recalibration you made in 2019, which itself was modeled on the mid-cycle adjustment of 1995?
It's more, I would put it more in.
Notice for the pressure is to the downside here. But these GLs, all this is all wrong. What I don't like on this market, I don't like the long here. I know it's a new high, all that stuff, all that thing, right? This low is exactly at overnight low. Next one exactly half back. I just saw this one. Exactly at overnight low. Exactly X to the tick, pretty much to previous period half back. Next one sell, right? Nasdaq is also, this is so bad here. This is so bad. Look, this is the worst here. If this market comes back to this area, well, the potential, I don't want to think what can happen here. Right? The thing is, it doesn't have to happen. Well, it doesn't happen, or it doesn't have to happen today. I want to check also what's going on with the 10.
Do that, but I would say the January number, which was very high, the January CPI and PCE numbers were quite high. There's reason to think that there could be seasonal effects there. But nonetheless, we don't want to be completely dismissive of it. The February number was higher than expectations, but we have it at currently well below 30 basis points core PCE, which is not terribly high. So it's not like the January number. But I take the two of them together, and I think they haven't really changed the overall story, which is that of inflation moving down gradually on a sometimes bumpy road toward 2%. I don't think that story has changed. I also don't think that those readings added to anyone's confidence that we're moving closer to that point. But we didn't. Last thing I'll say is we didn't excessively celebrate the good inflation readings we got in the last 7 months of last year. We didn't take too much signal out of that. What you heard us saying was that we needed to see more, that we could, we wanted to be careful about that decision. And we're not going to overreact as well to these 2 months of data, nor are we going to ignore them.
Hi, yes, Chair Powell. Could you speak a little bit more about the timing? Is there enough data between now and, say, May to be able to get the kind of confidence that you say that, you still need? Or by June, is there enough data for you? Just give us a sense of your thinking there. Thank you.
Yeah, so we make decisions meeting by meeting, and we didn't make any decisions about future meetings today. Those are going to depend on our ongoing assessment of the incoming data, the evolving outlook, and the balance of risk. So I really don't have anything for you on any specific meeting looking forward.
But, just a question of, is there even enough data for you to be able to?
We'll take,
Sorry.
Oh boy, look at it.
things can happen during an intermeeting period, if you look back, unexpected things. So I wouldn't want to dismiss anything. So I just would say that the committee wants to see more data
man, this
that
is
gives us higher confidence that inflation is moving down sustainably toward 2%. I also mentioned, and we don't see this in the data right now, but if there were a significant weakening in the data, particularly in the labor market, that could also be a reason for us to begin the process of reducing rates. Again, there's nothing in the data pointing at that, but those are the things that we'll be looking at coming meetings, and without trying to refer to any specific meeting.
Chris.
Hi, Chris Regaber, Associated Press. Thank you. In the projections, there is an increase in the neutral rate, as you know, and higher rates, a quarter point higher rates projected in 2025, 2026. Can you speak about what might be behind that? Is there a real sense here that the economy has perhaps changed in some way, that higher rates will be needed in the future? Thank you.
So you're right, they're pretty modest changes, but you're right, there was an uptick in the longer run rate, and also there's a 25 basis point increase in 25 and 26. In terms of are rates going to be higher in the longer run, if that's really your question, I don't think we know that. I think we think that rates were generally low during the pre-pandemic, post-global financial crisis era for reasons that are mostly, important, slow-moving, large things like demographics and productivity and that sort of thing, things that don't move quickly. But I don't think we know. My instinct would be that rates will not go back down to the very low levels that we saw, where all around the world there were long-run rates that were at or below zero in some cases. I don't see rates going back down to that level, but I think there's tremendous uncertainty around that.
Great. And just a quick follow on the projections, you also have 2.6% core inflation for the end of this year. It's already at, or you mentioned it being 2.8 in February. That doesn't sound like much disinflation at all. So are you still confident, or the last press conference you sounded pretty optimistic you would get more confidence to the end of this year. Is it right to say that this suggests you're not seeing a lot of disinflation this year compared to what we've seen 2023 and so forth?
I think that higher year-end number reflects the data we've seen so far this year, because you're now in this year. So I think that. Sorry, say your last part of your question again.
Well, just, are you still optimistic that you'll get the confidence you need this year?
I think if you look at the SEP, what it says is that
Say something here.
it is still likely in most people's view that we will achieve that confidence and that there will be rate cuts. But that's really going to depend on the incoming data. It is. The other thing is, in the second half of the year, you have some pretty low readings, so it might be harder to make progress as you move that 12-month window forward. Nonetheless, we're looking for data that confirm the kind of low readings that we had last year and give us a higher degree of confidence that what we saw was really inflation moving sustainably down to 2%, toward 2%.
Gina Smilik, The New York Times. Thank you for taking our questions. Per your comment to Anne that a weakening in the labor market would be a reason to potentially cut rates, or at least a consideration in making a rate cut, would continued strength in the labor market be a reason to hold off on rate cuts? And
Well, I see this kind of reactions from this kind of markets here. Very quick. We have a trade here. Market's going higher, right? Value higher, all that thing, right? But sometimes it is just as long as Chairman Powell keep answering this question, this will just do their thing, right? Sometimes it just didn't care when Chairman Powell said there's not going to be rate cuts. It didn't care. He just keep going, like pushing higher. They have now we have. I think I want to see how this market reacts once traders start finally buying, because there was a lot of selling here, and I want to see some buying comes, and it is not going to be unusual to see a lot of buying that happens right at the high, and then that can be a turning point. I'm not saying that's going to be the high, but I have seen that so many times before.
Neil.
Hi, Chair Powell. Neil Irwin with Axios. How do you assess the state of financial conditions right now, and in particular, do you view the kind of easing in financial conditions since the fall as consistent and compatible with what you're trying to achieve on the inflation mandate?
So we think there are many different financial conditions indicators, and you can kind of, see different answers to that question. But ultimately, we do think that financial conditions are weighing on economic activity, and we think you see that in a great place to see it is in the labor market, where you've seen demand cooling off a little bit from the extremely high levels. And there I would point to job openings, quits, surveys, the hiring rate. Things like that are really demand. There are also supply side things happening, but I think those are demand side things happening. We saw, that's been a question for a while. We did see progress on inflation last year, significant progress, despite financial conditions sometimes being tighter, sometimes looser.
You can see it, right?
Michael McGee with Bloomberg Radio and Television.
If this
Can
market
you give
keeps
us
shorting,
more color on
does keep shorting
how
up here,
the committee is
kind of
thinking about
keeps
inflation
keep
dynamics
providing
now?
fuel for this
What
rally
we've
to
seen
keep
at the
going
beginning of
higher.
the year, are they more one-off increases that will fade, or is there more of a secular turn with goods prices rising again and service prices staying sticky? And also, housing prices have been sort of the Godot of this cycle, in that you keep expecting them to go down and they don't. How does the committee see this playing out forward since you've raised your...
Did you notice the movement once the market, struggled here? It didn't take this one, okay? It didn't take this one. Market struggled. Then the work is way higher, back higher, no? And it started to gain momentum. I believe once this high was taken again, it gained momentum. Traders start to buy here again, and now it's low. You can see the trade, how the trade develops, right? I may not be part of that, but you can see it. What these guys are doing, what traders are doing.
We're going to let the data show. I don't think we really know whether this is a bump on the road or something more. We'll have to find out. In the meantime, the economy is strong, the labor market is strong, inflation has come way down, and that gives us the ability to approach this question carefully and feel more confident that inflation is moving down sustainably at 2% when we take that step to begin dialing back our restrictive policy.
Well, you've talked about the desire to have confidence that inflation is continually moving down. Has the recent numbers we've gotten for inflation data dented that confidence at all?
It certainly hasn't improved our confidence. It hasn't raised anyone's confidence, but I would say that the story is really essentially the same, and that is of inflation coming down gradually toward 2% on a sometimes bumpy path, as I mentioned. I think that's what you still see. We've got 9 months of 2.5% inflation now, and we've had 2 months of kind of bumpy inflation. We were saying that it's going to be a bumpy ride. We consistently said that. Now here are some bumps, and the question is, are they more than bumps? And we can't know that. That's why we are approaching this question carefully. It is very important for everyone that we serve that we do get inflation sustainably down. And I think the historical record, every situation is different, but the historical record is that you need to approach that question carefully and try to get it right the first time and not have to come back and raise rates again, perhaps, if you cut inappropriately, prematurely.
Thank you, Mr. Chairman. Edward Lawrence with Fox Business. I wanted to ask you, you received a letter from, the Federal Reserve, first independent body, understanding Congress has oversight over that. You received a letter from Senators Elizabeth Warren and Sheldon Whitehouse that said, calling on you to lower interest rates, to cut interest rates, because it says, quote, the potential that it may remain too high for too long has halted advances in deploying renewable energy technologies and delayed significant climate and economic benefits from these projects. So has higher interest rates caused that?
Have they? Well, first of all, I respect in our system of government, it is Congress that has oversight responsibility over the Fed. We place a tremendous amount of importance on our engagements with Congress and always treat them with great respect. In this case, I would say those are, our mandate is for maximum employment and price stability and the other things that we do. And that's what we're trying to accomplish. We're trying to do that in a way that sustains the strong growth we're seeing, the strong labor market we're seeing, but allows us to make further progress with inflation. That's how we can best serve the public and leave the other issues, which in many cases are incredibly important, such as those you mentioned, leave those to the people who have responsibility for those.
There was another letter from 24 lawmakers saying that the higher rates are squeezing the working people. How do these letters affect what you guys are doing policy-wise?
We receive these letters with respect, and we write careful responses and address concerns. We listen, again, because we're talking to the people who, in our system of government, have oversight over our activity. So but at the end of the day, we take that on board, but we have to make our judgments, and we have to stick to our knitting, which is maximum employment, price stability, supervise and regulate the banks, work on the payment system, the things that we do.
Claire.
Thank you. Claire Jones, Financial Times. Thanks a lot for the opportunity to ask a question. As chair of the FOMC, would you want to see unanimity on the committee or something close to it, meaning no more than one dissent before you begin cutting rates? Thank you.
We're a very consensus-oriented organization, and we do try to achieve consensus and ideally unanimity. People do dissent. It's something that happens. Life goes on, and it's not a problem. We've always had dissents, and so and you respect thoughtful dissents very much. It's like you may not agree with some arguments, but you really want to understand them. So you may read a book that takes a position that you have long opposed, just to understand that book. So I treat dissents with real respect as well.
Simon, one will be available.
Simon Urbanovich with The Economist. Can you hear me?
Yes.
Okay, great. Obviously, inflation is some ways away from target. Unemployment, though, if you look at the projection for the full year, 4.0%. In February, we were already at 3.9%, so quite close to the median projection. Are you concerned at all that, notwithstanding the very strong jobs growth, that in fact there may be some cracks appearing in the employment market? You talked about a significant deterioration in the labor market being a condition for easing rates. What would constitute that in your books? Thank you.
So we, of course, monitor it's one of our two goal variables. We all monitor the labor market very, very carefully, and I don't see those cracks today. And we follow all the possible stories that are out there about there being cracks. But the overall picture really is strong labor market, the extreme imbalances that we saw in the early parts of the pandemic recovery have mostly been resolved. You're seeing high job growth. You're seeing big increases in supply. You're seeing strong wage growth, but wage growth is gradually moderating down to more sustainable levels. In many, many respects, things are returning more to their state in 2019, which we can think of as normal for this purpose. That's job openings and quits, and surveys of workers and businesses are always interesting on this. You know, how tight is how easy is it to find a job? How easy it is to find a worker? Those surveys have both come down. So the labor market's in good shape. You know, you do see things like the low hiring rate, and people have made the argument that if layoffs were to increase, that would mean that the net would be fairly quick increases in unemployment. So that's something we're watching, but we're not seeing it. Of course, initial claims are very, very low, and if anything, have tracked down a little bit. So watching it carefully, don't see it. And when I say something, I use the term unexpected weakening in the labor market. So, you know, we do expect the unemployment rate to, you know, the forecast is that it would move up, I think, closer to what we see as the longer run sustainable level. That's just people's forecast, individual forecasts. But we're talking about something that's unexpected. That's where I'll leave it, though.
Steve.
Steve Matthews with Bloomberg. You mentioned at the beginning of the press conference that the committee felt it might be appropriate to slow the pace of asset runoff fairly soon. I'm wondering, when you say fairly soon, does that mean that the committee would meet about this again in May and a decision could be reached that soon? And I was wondering if you could also just describe the scope of what the committee is discussing here. You're at $95 billion of caps right now. Would that be cut about in half or something in that nature? Thank you.
So that is what we're discussing, essentially, and we're not discussing all the many other balance sheet issues. We will discuss those in due course, but what we're really looking at is slowing the pace of runoff. There isn't much runoff among MBS right now, but there is in treasuries, and we're talking about going to a lower pace. I don't want to give you a specific number because we haven't had an agreement or a decision, but that's the idea, that's what we're looking at. And in terms of the timing, I said fairly soon. I wouldn't want to try to be more specific than that, but you get the idea. The idea is, and this is in our longer run plans, that we may actually be able to get to a lower level because we would avoid the kind of frictions that can happen. Liquidity is not evenly distributed in the system, and there can be times when, in the aggregate, reserves are ample or even abundant, but not in every part. And those parts where they're not ample, there can be stress, and that can cause you to prematurely stop the process to avoid the stress, and then it would be very hard to restart, we think. So, as something like that happened in 19, perhaps. So that's what we're doing. We're looking at what would be a good time and what would be a good structure. And, you know, fairly soon is words that we use to mean fairly soon.
And will there be a discussion about returning to an all treasuries balance sheet at some point?
So that our longer run goal is to return to a balance sheet that is mostly treasuries. I do expect that once we're through this, we'll come back to the other issues about the composition and the maturity and revisit those issues. But it's, you know, not urgent right now. We want to get this decision made first, and then we can, when the time is right, come back to the other issues.
Victoria.
Hi, Victoria Guida with Politico. Also on the balance sheet, you know, can you talk a little bit about how the outlook for the banking sector might impact your balance sheet plans? Do you worry that as deposits start to shrink that we could see more turbulence?
You know, we'll be watching carefully.
The bond market is now closed. Bonds also close above. Let me know, where are you? Where it would bonds actually close higher, and now they are out of the way. There are this part. There was firecracker effect here, potential to the downside. Just this was just removed, and now this market close higher, kind of like relief. There's some relief in the pressure here. That was that this market was going to the downside. There is some relief here, closing higher about this 3-day range here. Now we have two distributions. This becomes really important, and this is getting closer to the 90 to 90, or closer to this 56, another century number there. Can it make it? Who knows? As long as Chairman Powell keeps answering, and as long as the round of questions is here, I think this market can keep doing what it's doing now.
That as the balance sheet shrinks, we should expect that reserves will decline pretty close to dollar for dollar with that. That's what we think.
Go to Jean.
Hi, Chair Powell. Jean Young with MNI Market News. I wanted to ask also about the balance sheet. Will you said that starting the taper sooner could get you to a smaller balance sheet size. Does that mean you don't have to make a decision on when to end QT at this point, and will you be setting up the process for deciding that sooner, or will you wait until we're close to the end?
So it's sort of ironic that by going slower you can get farther, but that's the idea. The idea is that with a smoother transition, you'll run much less risk of kind of liquidity problems, which can grow into shocks and which can cause you to stop the process prematurely. So that's where, in terms of how it ends, we're going to be monitoring carefully money market conditions and asking ourselves what they're telling us about reserves. Are they, right now we would characterize.
That was a nice question. You got here the Dow has making new highs. Yes. Guess who's missing? It's really close. It's not that far. The Nasdaq can move this really long distances here. This is nothing for the Nasdaq.
In particular, a bunch of different indicators, including the ones I mentioned, to tell us when we're getting close. Then, though, you reach a point.
When this market held, when ES was trading towards this low, this market was really close. I mean, this was the potential to the downside was huge here. But we talk about this market, right? If this market held, that potential it just remains there, right? It doesn't go away, but it's there. But it's not taken today. It doesn't explode. It doesn't happen today. When this happened here, this holds now. Let's go back and test this high again, right? Or whatever the high was before.
Above what we think the lowest possible ample number would be. We're not trying for that. We want to have a cushion, a buffer, because we know that demand for reserves can be very volatile, and we don't want to again find ourselves in a situation where there aren't reserves. We have to turn around and buy assets and put reserves back in the banking system the way we did in 2019-20.
Hi, Nancy Marshall-Genzer with Marketplace. Chair Powell, you said you're waiting to become more confident that inflation is getting to your 2% goal before you cut rates. Can you just sum up more specifically what data you're looking at that would give you that confidence?
Sure. So most importantly, we're looking at the incoming inflation data and the contents of it and what they're telling us. So that'll be, and also the various components. So obviously that's what we want. We want more confidence that inflation is coming down sustainably toward 2%. And I mean, of course, we'll also be looking at all the other things that are happening in the economy. We'll look at the totality of the data, including everything essentially, as we make that assessment. But the most important thing will be the inflation data that's coming in.
Well, are there things that you would give more weight to, like wages?
Wages is one thing. We don't, our target is not wages, it's really inflation. But we would look to the fact that wages are still coming in very strong, but they've been wage increases, that is to say, wage increases have been quite strong, but they're gradually coming down to levels that are more sustainable over time. And that's what we want. We don't think that the inflation was not originally caused, I don't think, mostly by wages. That wasn't really the story. But we do think that to get inflation back down to 2% sustainably, we'd like to see, continuing gradual movement of wage increases at still high levels, but back down to levels that are more sustainable over time.
Go to Greg.
Thank you. Greg Robb from MarketWatch. Chair Powell, could you say at this meeting whether there were more officials who wanted to be careful and go slower about rates than were at the last meeting? Was there that sense of maybe it's smart to wait? Thanks.
I guess I'd put it this way. If you look at the incoming inflation data that we've had for January and February, I think very broadly that suggests that we were right to wait until we're more confident. So I think I didn't hear anyone dismissing it as not information that we should look at or anything like that. So I think generally speaking, it does go in the direction of saying yes, it's appropriate for us to be careful as we approach this question.
Brendan.
Thanks, Chair Powell. Brendan Peterson with Punchbowl News. I wanted to ask you about central bank digital currency stuff. We've been hearing a lot from Republicans in Congress about what the Fed is or isn't doing in a digital dollar. But folks, I know you have said to Congress that you are going to wait for approval before the Fed does anything, launches anything. But folks like House Majority Whip Tom Emmer have said that the Fed is either actively researching or hiring personnel to study the implications of a CBDC. Can you give us any clarity on what the Fed is doing right now on a digital dollar?
Sure. So I think we've been pretty transparent on this, but I'll try harder. So we are not getting ready to, we haven't proposed, we haven't come to a conclusion that we should propose or anything like that, that Congress consider legislation to authorize a digital dollar. And it would take legislation by Congress signed by the President to give us the ability to do what we think of as a CBDC, which is really a retail CBDC with the public of it. So we're just a long, long way from that. What we are doing, and I think what every major central bank is doing, is we're trying to stay in the frontiers of what's going on in digital finance. And it has many, many different areas. It has applications in wholesale finance, in the payment system. And so to serve the public, these issues have become very front burner in the last 5 or 6 years. We need to be knowledgeable about all that. So we actually do have people trying to understand things that are, but it's wrong to say that we're working on a CBDC and then we've got.
So what you guys are doing here? Are you shorting the market? Okay, not just because the market is really high. It doesn't give me no reason to short. I did a couple of trades on short side though. Okay, when the market leaped market started here. This spike to the upside. I was late. I guess when I went short was when the market get back inside the range, inside the 19-day range. I closed when the market didn't have downside continuation inside this range, and the second time I was in. I also let it go when I started the market struggling here, have a lot of struggles, and the Nasdaq was holding. I was watching closely to the Nasdaq because that was key. If that market breaks, this will have just how to join the party, kind of like force it, right? maybe just to take this low or maybe this one, but not in the significance of as Nasdaq. Also, this level was important to me. That's like an intraday, intra-period reference, right? Once the market didn't have downside continuation here, as soon as the market took this area, this 55, that was it. I didn't look back to the lower side, to the downside. In terms of placing any trade, I am not long. I have no intentions to do any long here.
Report, financial stability report. I mean, there's a long list of things that we've done. I think I mean, nothing comes to mind as really desperately in need of doing at this moment. We're very transparent. We have no shortage of FOMC participants speaking to the public through the media. And so that channel is full, I would say. So I think it's generally broadly helped and made things better, but not every day and in every way.
Well, to follow up, has there ever been a day where you wanted to put that genie back in the bottle somewhat?
Of course not.
Let's go to Jennifer for the last question.
Okay.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo
about
Finance. Not to harp too much more on confidence and inflation, but you did say earlier in this press conference that the recent inflation data hasn't raised anyone's confidence. But when you testified before the Senate a couple weeks ago, you told lawmakers that you are, quote, not far from receiving the confidence needed on inflation to begin cutting rates. So are you still of that belief or not? What are we to take by those words, not far?
So let me say my main message at that in those 2 days of hearings was really that the committee needs to see more evidence to build our confidence that inflation is moving down sustainably toward our 2% goal, and we don't expect that it will be appropriate to begin to reduce rates until we're more confident that that is the case. I said that any number of times, so those were kind of the main part of the message. We repeated that today in our statement. I also, to the language you mentioned, I really pointed out that we had made significant progress over the past year, and what we're looking for now is confirmation that that progress will continue. We had a series of inflation readings over the second half of last year that were really much lower. We didn't overreact, as I mentioned, but that's what I had in mind.
But given that you said that PCE for February, 2.8%, the estimate, and that we have been seeing PCE, core PCE, coming down by 10% every month, I mean, wouldn't you be at about 2.4% this summer, June, July, to a point where you could cut then?
Well, we'll just have to see how the data come in. We would, of course, love to get great inflation data. We got really good inflation data on the second part of last year. Again, we didn't overreact to it. We said we needed to see more, and we said it would be bumpy, and now we have January and February, which I've talked about a couple of times. So, we're looking for more good data, and we would certainly welcome it.
Thank you.
Thank you.
Thank you.
All right. The press conference is over. The only thing that financial juice had is quite high, but this seems to be important here. They were high, but probably just adjustments, right? Which means that the number was actually good, was not bad. As the announcement was at the time. Now, with Chairman Powell done, let's see what this market does. This looks, inventory is super long here. Very long, very questionable, coming from Cedar Hill, coming from Halbach Hill, coming from overnight low here. And with these days, multiple distributions here, right? But also, remember, there's a cluster of highs we have here, right? Cluster of highs, we have an all-time high. Nasdaq, the all-time high the Nasdaq has is, I believe it has 2 ticks, 3 ticks excess, which is basically nothing for that market. 7, 8 points excess in the ES is good, and Nasdaq would be 2 or 3 times that. This is another distribution that is forming here. Very elongated, another emotional trading going on here. Notice how this dries here, but who cares, right? This is new highs. I did my trades here. The important, the key here for any trade that you place, because you have to monitor for continuation. And to monitor for continuation, you have to be monitoring the market all the time. And try to identify, you may not be part of the trade, or we may not be part of what the market is doing at the moment, but when we are watching it, we kind of like try. That's what's called getting in sync with the market, right? You know what the market is doing, and what it's trying to do, how it's doing it, and then you monitor that. Then you realize there is something, because markets don't go straight up, and don't go straight down also. They make ranges. There's actions to the upside, actions to the downside. Now there is something is changing here. This thing here, it's not wrong. Notice how is here got this short. This is shorting. No, this was all positive before this last round I had. I'm not looking anything here. I'm not looking to go short, but I'm not going to be long here. Not now. It's too late in the session. It's 3:35. There might be some rebalancing, or maybe another attempt. Okay, what is 50? Okay, I say 56. Why I say 5,600? It's 5,300. The heck I was thinking. I remember I talked about 5,600. No, I'm crazy. 53 here. I hope everybody had this kind of these are news events, right? I don't trade news events. Sometimes you can see some opportunities, but the safest, you be better leave the market alone. If you don't know what the market is doing, again, not necessarily today, but in any other circumstances, if we don't know what the market is doing, why I'm going to do something, why I'm going to be short, why I'm going to be long, if I don't know what the market is doing. The first thing is getting to know what the market is doing. What most traders do is momentum trading, and because that's the easiest strategy, you just go with price. Traders saw this market going high. Oh, okay, let's go long. Or if the market comes lower, I'm going to be short. They don't care about what the surrounding circumstances are. They don't care about the context. They just go long or short because the prices are going higher or prices are going lower. Right, and that is momentum trading is the easiest, and that's why most traders do that. We also know what happens to most traders. You may say, okay, I just did a couple bucks or maybe a couple points or whatever. No, but it is not them. Just as we talk early today about decision making, sometimes your decisions are not going to have good results, But if you are consistent in time, the results will show. Just is like going to the gym. You have to be consistent with something, but you need to get to know yourself, get to know the market, then build your strategy, and then stick to it, do the adjustments, and adapt. This is all. These markets are always changing. Markets are not the same all the time. They are always changes. What I'm doing now, for example, is I am monitoring this contract, the June contract. What happens? It's going to be, the market or the trading is going to remain as the same as the last one, the same as the first 2 months of the year. Is there any change that I can watch, that I can feel, I can say, I can observe? Is there any change relative to the previous contract, for example? That's what I'm doing now. Now, another thing relative to trade also. I have this is a comparator. What do I have here? Let's check. On the left side. Oh boy. Okay, let's do 150 and let's do 250. And on the left side, I have contracts that are above 150 and on the right side above 250. Let's hit apply here. I thought I already recorded this, but let's see. Well, there's some blood. When I start to see a bunch of those things here, that's also an indication of that the movement may be coming to maybe reaching this last part, but I don't see that here. Now, okay, this is something that I forgot. I missed this thing. And we have higher volume now. For the magnitude of this movement, this volume is actually not that much. It's going to be a little bit higher than yesterday. How much do we have here? This is higher regardless at the closing. Right. Many times, so many times, I got burned and I got killed when I tried to trade these news events. When I saw the market going higher, I went long. Just as soon as I went long, the market goes lower. Oh, I got short, I played me short, the market goes back in the opposite direction, right? That's FOMO, right? And then the next thing you know, I got over trading. Next thing, revenge trading. Next thing, okay, I just get killed, right? You got to be patient here in this market. The market is going to be there all the time. The market is going nowhere. Opportunities are going to be here. You didn't get positioning for the movement. You were not hedged. Okay, so this is. This market is not going to close today, It's not going to be over. It is always going to be here. When markets get out of balance, usually it's bigger time frame participants that take the market out of balance, right? In the morning, we saw this movement from this area here, taking this high in a really weird way. After that, you by watching what happened after that event, we can say that those were not strong traders. That was one specific trade aimed to take just the stops that this market has above this. And that was it, a couple ticks. And believe it or not, that's a trade, right? Somebody just buy into this, buy this one, huge volume, and then just sell into that. And if there's something serious, the market come back and take that level. That didn't happen now, right? I'm not talking about J, but K here, right? When this movement comes back, and I trace it, that's a different movement. But can you remember what happened here? Why this is happening now? If we get too attached to the emotions, or if emotions take control, we completely forgot about what happened here. Not because this has to do to what's happening or what was happening here, but the way how the market does something is what matters. Or in any case, what matters today, right? How this happens, right? It goes back and forth, back and forth, back and forth, and then, so let's go, right? There's another. Value at this moment was overlapping higher, right? I was doing a trade against the value. That trade has to work fast. And I decided to use that, or to do that trade, because I saw potential in that trade. The risk I was taking wasn't that big, and the potential was huge. It didn't play out. It didn't play out. Okay? I am not negative. I have a small profit here, but I am not negative. Right? But the thing is, when you have context, even when you do trade against the trade against value, you know that fact, right? You don't let the market go too far against you before taking any action. You understand the context. If I go to short, just because the market is too high, that's a completely different thing. That's kind of like trading or taking a position, with hopes, right? With hopes the market doing something. And that is something dangerous. That can be dangerous, but we all go through that, okay? And if somebody say that they didn't experience that, and they didn't live that way, I will have my doubts, right? It can happen. Maybe somebody has a good, proper education, or starts in this business in the right way. It is probable, okay? There could be, that can be done that way. But most of us don't start that way. Most of us start, in these chat rooms, trading MACD, RSIs, or Fibonacci's, or cycles of the moon, or even, stuff like that, right? Which is not right, right? I don't know why I have this here. I was talking about this action here, right? Now, carry on, moving on. I got this level. What the market is doing here made me question the movement. From yesterday, this is we don't have excess, very emotional market here. Now we have a low exactly the overnight overnight low, couple ticks from POC, and this POC is, I start to watch this market also. I start to see POC once the market becomes rotational here, because trading days don't have POC. That's the second. The first thing, the other thing is coming exactly from half back. But K here, when K happens here, I guess K started somewhere in here, something here. First thing started coming back inside 19 day range. Then it takes this level that I was checking for the period, for this period in particular. There's that one, this one get back inside. But once the market finally gets back inside range, because this was like the fourth or fifth attempt this market made to get back inside this range until it finally did it. But it just didn't have it. You know, it was struggling, moving one tick at a time, 1, 2 ticks at a time, you know, moving. Oh, okay. I mean, when I saw that happen, gosh, this is. You know, I don't need to see, right? In this case, right? The market is telling you, you know what? No, get out of here, right? Unfortunately, we don't learn this. You know, nobody can teach us that, but this is just experience. You know, markets tell you, get out of here, or I'm going to kill you. And I close. I didn't know Seth was here. I was just watching the movement, and I closed. You know, and then when the market came back up to here, okay, Seth is here. I thought maybe the market can come back, but that actually was the base for the move. And then it had upside continuation. All signs were positive. At this moment, taking these highs out, they making new all-time highs, not having acceptance inside the range. Nasdaq holding. Bonds were, I guess also at that moment, the bond market was back above this high, above this daily. We have this range here. It took this high back again, right? And it was far from the lows. That's another thing here. And as you can see, trading is not it's not not easy, right? It's not as easy as okay, I want to be long here or I want to be short here. You just have to keep the main part is monitoring for continuation. The last thing I want to be here is let me tell you, the last thing I want to be is long. I wonder if anybody would want to be long when the market closes. Okay. Now, how far this market is going to come back? Can this market come back to hard back? It's pretty much right there. Nice buying from hard back or as close as possible to hard back. This is another sign. Who buys from here? Right? This is, it's actually too late in the session. Right? Too late. Inventory is too long here. This is changing now. If something changed here, this was kind of 900, now it's 12. Volume is low. I want to see the things 8, 7, 8, 9, 10,000 here. When that happens, that will tell me, okay, this is where the market can sell. Until I see that, I see tremendous risk here. On both sides, market can keep going higher here. Nasdaq. Where's the Nasdaq? The next reference in Nasdaq is the all-time high, but it's kind of far from. It's 90 points. It's for the time we have only 20 minutes. That market is especially weak, my friend. This is really weak. Oh, that also has 1, 2, 3 distributions over there. All right. I don't have nothing else here. I hope you have a good day. Most of the times we just have these days as educational days. These kind of days are not easy. we may see this market as a big opportunity, right? Oh, this market has like 50, 60 points range to the upside. Yeah, I could have been long here. And it's unfortunately it's not that easy, right? I hope you have a good day. If not, just what we do is we lick wounds, take notes, what went wrong, what was right, make the adjustments, and move to the next trade. What happened now after today has nothing to do. Whatever trade I made today has nothing to do. Whatever trade I made before has nothing to do with the trade I'm going to do next. Getting rid of that feeling, that emotion is also important, because I can feel fear if I had a bad day or I have a wrong trade, or if I didn't have any wins. Or I can get too cocky if I get all my trades were right. Both things are not good. Both things play against us. All right. I hope you guys have a wonderful rest of the day. And unless there's any questions, I'll call it a day and wish you a wonderful night or rest of the day, wherever you are in the world. See you.